right, I'd like to welcome everyone to today's session. When we talked about building this particular webinar, we got a lot of requests from people to really do this because it's been a while since we've come around to handle this type of teaching. But given the fact that we do have some people who don't know anything about technical analysis, or we're starting from scratch here, and that we're going to try to get a good preview of what technical analysis can offer many of you. Some of you are quite seasoned, as I've seen, so for maybe the intro part, you're going to have to bear with us because I have to be able to lay the foundation for the rest. And later on, as we come around and talk about trends, then we can start elaborating on some of the things that we normally use as a trader. We're dividing this session into 4 parts. Today, we're going to cover spotting and identifying, spotting, and following trends. We'll talk next about corrections and area patterns in the second session. On the third session, we'll introduce technical indicators. And on the fourth session, we'll put everything we've learned in those last 3-week sessions and try to be able to give everybody a much more wholesome exercise of how these collaborative efforts by different indicators and points of view will actually work together. All right. So in our ability to carry over, I'll now move on into my presentation. Okay, so since we're going to be talking about an introduction to technical analysis and of course what trends are going to be all about and how we're going to make use of it, let's just run through a quick outline of what I'm going to be talking about today. So we will start off first by understanding what is technical analysis, why do we need to use this? I'll give you a definition and of course working knowledge on how to be able to understand why we study this and how market price becomes of great importance to us. And of course, I'll have to show you how to use graphs and how to use some of the indicators. We'll probably do that in the next few sessions as well. In terms of the main content, we're going to start with the very essence of what technical analysis is all about, which is really trying to identify what trends are and how do we go ahead and subsist or stay with the trend as long as it lasts. Because there's good money to be made over here, and it will not help if many of the things that we learn tend to be more confusing and just shooting us in and out of a situation and does not allow us to be able to partake of what these particular up moves or down moves may actually hold for us. And under the conditions of trends, we'll talk about what a bull and bear market is, what is support and resistance. We'll talk about how to draw such trend lines, and we'll try to be able to cap off by giving a demonstration on how to put those things together. Okay, normally one of the biggest questions I usually get after my seminars are usually, what books can I make reference to? So I'll put that up front right now so many of you guys can have a look at some of the prime reading materials that people come to do. The first 2 are pretty much core technical analysis books. They're pretty thick, but these 2 authors, John Murphy and Martin Pring, are pretty much the bedrock of what technical analysis is all about. I would prefer you read the first rather than the second, because the second, it's very detailed and it's written in such a way that might take some gearing in your end. So John Murphy has a much easier English style, so you might really want to be able to look at that. Then, of course, the Master Swing Trader is something you want to look for, Alan Forley. This will give you a good hand of how to best time the movements of the market, because as it's called a swing trader, it gives you conditions that you really want to look for looking for potential setups into the market. And there are a lot of other books that kind of talk about swing trading, but I think this might be a good primary book to start off with, and you can probably look at the rest. For those who are interested in looking at Japanese candlestick charting techniques, the Bible for Japanese candlestick charting is really a book by Steve Nissen, and it's quite illustrating, and so you really want to have yourself some time to immerse yourself in what this is all about. You don't really need it immediately, but if it's something that you want to look at later, especially for those who want to look for patterns inside the Japanese system, then I wouldn't suggest it. I mean, after this, you don't really need to read too many books on Japanese candlestick. This one can do everything for you. Also below, I've indicated some URLs that you probably want to visit for like stockcharts.com, bigcharts.com, and even TradingView if you want to be able to have a look at certain stocks. Big charts could even give you charts in the Philippines. All you have to do is put a PH colon and then your local stock symbol to have a look at what the chart would look like. Also, for those who want to further their education here, under stock charts, they do have a area there called school.stockcharts.com/docu.php, and in here you see a lot of references on the material I'll be talking about today, and it's really very educational. So when you have time, do go ahead and do that. The author of this is actually the author also is John Murphy, and he's contributed to the articles into that website. So at least you know that you're learning from someone who's quite experienced already into the industry. Okay, so before we begin the other things, let's just get good foundations in why we're doing this. Let's first try to be able to understand the differences between the two types of analysis that normally investors want to be able to review on. There is such a thing as fundamental analysis and, of course, technical analysis. These are the two branches in analyzing stocks. The first, fundamental analysis, talks about reviewing your economy, industries, a company's financial statements, how's management coming along to be able to build a business well, and its primary goal is to try to evaluate what are the prospects for a company's growth and how valuable is the business given the context of what it's doing. And it answers the question, is a company cheap or is it too expensive? And by answering that type of question, you'll be able to get a sense of whether it should be timely for you to be able to look into a prospect of investing in a stock or not. Now, technical analysis does something completely different. Now, technical analysis does not look at growth and value. It leaves that up to fundamental analysis. But technical analysis reviews the movements of prices in any market or any security. It studies movements in trends, area patterns, and momentum. And its basic assessment really is to try to evaluate these movements in price and see whether is there demand or is there too much supply coming into a situation that might push a stock up or down. And we'll try to reveal a bit more of that when I start giving you the primer as we come along. And the basic sense of what technical analysis does is it answers the question, is it the right time to execute your buys or to execute your sell? So in the other way, in fundamental analysis kind of tells you cheapness or being expensive. So that tells you whether you should be looking to a company because it's cheap to make an investment, or if it becomes too expensive, then you'd sell. Whereas technical analysis will look at the buy and sell purely by looking at the movement and the intonations of what price does. And that's the only input that it really wants to be able to look at. Price and maybe along with volume together, they should give you good depth into understanding what markets are doing. Now, in terms of being an investor or trader, technical analysis is really for the trader. If you're wondering what the difference is, an investor normally when you buy into stocks, you're really buying that for a long-term prospect haul. You're looking for preferred values or discounts in prices so that make me quite warranted for you to invest in it so that your upside later on can be quite telling. So you start setting a position when it's kind of fairly priced. And little pullbacks in price should not worry the investor because you're gearing for the long term, and little price hiccups should not really bother you so much. Now, I know it's easy to say that, but when prices are coming down, of course, it's really quite telling because your emotional well-being is put to the test when that happens. Now, as a trader, you do things a little bit more differently. You start looking for buys and sell windows into stocks more into the shorter term rather than too much in the longer term. Your entry and exit plans are driven by set rules, which we will talk about into the next few sessions. And your aim here is really to try to generate better returns than what just investing would do. And if in the end you don't get to do that, then you really probably want to just come inside and become an investor, and you probably just want to look at mutual funds or index funds to be able to score it up if you feel that all of this is just too difficult for you to do. And so I wouldn't say that technical analysis will be for everyone, but I think everybody can learn it. Now, how well they learn it and how degree of mastery they can come in really depends on how you are. What is your mental condition like? Are you a very stable person when it comes to trading? Or if prices are moving up and down, do you really get shaken out right away? And that all changes things. And that's why you have to know that your risk tolerance here becomes very important. And one thing for a trader that he manages quite well is the essence of risk, because risk is everything. We can only start trading as long as we have the ammunition to trade. And that means if I do have the funds to trade, then I can be alive and I can be a participant and I can have the ability for the market to be able to give me something. But the minute my capital washes away, the ball game ends. And that's why it's very important here that trader understands that he can only stay in the game as long as his funds remain quite appropriate to be able to do that. So here, the essence of risk, we watch quite carefully, and we will not allow ourselves to step over an open manhole and allow us to drown ourselves back into a very deep loss. So all the things we'll be learning today will teach you how to be able to look at the market, how to be able to position yourself correctly, how to be able to make sure that when you take a trade that you don't take too excessive amounts of risk, and how to be able to make sure you drown away all the little noise out there and only pick the particular trades that's really warranted for you. And this is what trading through technical analysis will give you. Now, if you're probably wondering, do I really need this to become a trader? And I would probably say, yes, you do. And the reason for it is because one thing is quite clear for all the markets that you've come to trade. Yes, on the long run, the trend bias for many of these companies will likely be on an upward path. But that upward path, unfortunately, is not a straight line upwards. You will see that many times you will get quite wild gyrations, like you will say here. And so one thing that comes along with these movements is price volatility. You can see in the image that I have over here that you can see prices going up and down several times in the course of the number of years. And you might think that, oh, wow, it still looks okay because prices are leading up to a nice high price. But along that pathway, you're going to see sessions that are coming down, and it's going to put your emotional bearing into the test. And it's really because of this that you have to make sure that the discipline has been ingrained correctly. Because without this discipline and your ability to follow these trading rules, that your ability to get shaken out and to be able to get scared off a trade or to enter at the wrong time, all of this will be muddling your mind during this particular condition. And of course, the questions. As prices move up and down, you probably are wondering, am I doing the right thing? Is the system I'm following telling me the right thing? Am I reading the statements of a company or its trends quite well? And so a lot of these questions will come up. And to those people who are only doing this for the first time or are trading for the first time, you can just imagine how difficult this probably would be, because you're going to be feeling things that you've never felt before. We're talking about exposing our cash into a certain level of risk. And whenever that's put into some degree of risk or danger, and here's where your emotions will sway you and will try to create an element of doubt all throughout. So it's very important that this discipline is imparted correctly and that you practice this over time. This is not going to be a session that you're going to learn overnight and tomorrow you become a master. This you will master the concept quickly, but do you apply it correctly? When emotion comes in, that could throw everything out of whack. So it's very important for you to be able to make sure that a lot of things you do, you practice over time so that you can build up your level of confidence in following the systems correctly. And then you will see in due time, you will get to where you want to go. So this becomes a very big opportunity for the skillful trader. And the reason for that is because the skillful trader puts his emotions in check, knows when to call things off when things get too difficult for him. He understands that he shouldn't just be jumping into anything every time you see any price movement. Things are qualified over here, and that your ability to follow what the market is telling you is topmost importance, because you can't allow your emotions to take control of you. If you do that, then this is not going to be too viable for you. Now you might say, I might just buy a stock and stick it out for the longest time, and I know anyway at the end of the day prices will eventually recover and go to a new high. Yes, that may be right. The problem I'm feeling over here though is, how long can you tolerate that in between that session? There may be instances in our market where some declines that we would see may be quite arduous. In fact, if you look at this situation here from 2000 to 2003, from the period of 2008 to 2009, and just recently with our market coming down from 2019 or mid of 2018 to where we are just recently in early 2020, we had quite a bit of a fallout in prices. Now, you might have been saying, if I bought this market closer to 8,000 and you're coming out with the argument saying, that's okay, I'll just stick it out as long as I can. But as prices go from 8,000 to 7,500 to 7,000 and you start sweating it out and you can't seem to understand, hey, wait a minute, the market's supposed to be going up, why is it going down? And then it goes to 6,500 and you say, hey, wait a minute, it hasn't gone to 6,500 since 2014. What's going on here? This market's supposed to be going up. And then it goes back to 6,000, goes less than 6,000. And now you're rubbing your head and your temples are aching and you can feel the stress environment inside you. And every bone in your body is saying, what am I doing wrong here? And everything that you want to do is just want to press that exit button to make this pain stop. I've seen this happen before to even the best of traders. And even the best of traders during a market plummet can really feel that degree of stress. And so I know it's easy to say, I'll just stick it out all the way through and just hope that time in the market will redeem me over in time. But can you stick it out? If you can, my hats off are to you. Go ahead and stick it out. And I'll see you one day when the market makes it to a new high. Who knows? Maybe 1, 2, 3, or 4 or 5 years from today. But in the meantime, some positions are losing money. The value of my capital is decreasing. And as I'm pinned in a stock, it prevents me from looking for opportunities in another stock. And these conditions are not acceptable to a trader. A trader wants to be liquid during times like this, so he has the opportunity to jump into that next setup. And if I'm pinned in something and hoping for the next 3 years a redemption in price into a new high, then that's 3 years of me not being able to do anything. And traders don't want to get into a mess like that. So what do? They need an essence of a science that can help them navigate through this particular type of condition. Today, we're going to learn technical analysis. This is the second type of analysis that dwells with looking at price and looks at trends and gives us an essence of what we ought to be doing in a market rather than just saying in the name of the Father and the Son and the Holy Ghost. Hope will not help us here. It can help us keep us in the position for a while, but remember, God says that they help those who help themselves, and that means you have to be the driver to your degree of success. And if you need once in a while to pull that parachute to safeguard your capital, then it's time for you to pull it. And know that it's time for you to jump back into position. It's time for you to jump back inside. And so your confidence in a system is what's going to make this happen and what turn all this into a very profitable situation for you in the long run. So what is technical analysis? So technical analysis is a study of market action. It's primarily used really is to be able to show you charts or graphs. And so we can see things in a very visual manner. And the objective really here is to be able to see that you can forecast whatever the future price trends of something is. Now, I can't just give you the importance of a definition like this because it's broken down to 3 things. So technical analysis studies market action. That means price. And we're going to look at the movement in price to give us a good head of what is happening in the market. We will use charts and graphs because of its visual nature. It allows us to look at prices in a single view, in a graphic form, so I can get that impression immediately, rather than looking at so many numbers might take me such a long time. And it'll allow me to be able to forecast what these trends are telling me prices are going to do. And so it becomes very valuable now to a trader because a trader timing is everything. And without that essence and not seeing a medium like chart or a price to forecast what I want to do, then you'll probably just be guessing when you buy your first investment. We need to be guided somehow here, and that's why it becomes very important to be able to do this. All right, now let's try the base essence over here. Why is market price so important? Well, market price is important because we believe that the price of a stock or an index or whatever it is that you're trading has everything built into that price already. So if you're talking about Ayala Land trading at a certain price, it's there for a reason, because the market right now can tell you that it's factored its earnings, it's factored the disease that we're currently situated into the Philippines today and the world. It's factored what's happening to GDP. It's factored what's going on in people's mind. It's factored in a lot of things, what's happening to the investor, whether they have money or they don't, or they're feeling tightness now during this lockdown period, a lot of things. And as all that is pushed into the price, whatever you see at the market today is just a summary of all that information being pegged into that price. And that's why it becomes very, very important. Everything is built into it already. Second, prices move in trends. Now, when we start looking at graphs later, you might be seeing graphs going up and down and up and down. You're probably wondering, my God, this looks so chaotic. And why is it going up one moment, going down the next moment? And the reason for that is because the market keeps swaying. It's swaying because of the sentiment of how people are feeling. And that sentiment lasts for a while and creates what we call market trends. And as these trends come in, a trend lasts for a while. It could be trends lasting for a few days, few weeks, a couple of months, maybe even years. And so our job as a technician is to look at those trends, identify it, and try to follow it as long as you can. And if a trend shows you that it's still pushing up, no matter what it's been doing, then why should we be selling if the trend looks like it will continue to move higher? And these are the things that should come as good rest back for us, because our ability to stick with a stock is dependent on what that trend is telling us. Third, prices move in trends, but when they move up and down, they tend to repeat certain types of patterns of behavior that they do. And that's why we say history repeats itself with prices. Now, the reason I'd like to be able to prove that to you later on, especially when we talk about area patterns in session number 2, will give you a sense of markets moving and the certain types of behavior that we're going to try to be able to pull out of it, so that we can use it in the future when we see it again to tell us that it's done this before and more likely it will do the same thing again now. And as we see that element come in, it gives us the ability to predict what the market will do by looking at that historical significance and trying to impart on a future date what it could do again. And that makes things very, very powerful for this particular science, because not only does it give you a medium to be able to look at the market, which is price, because sometimes if you're looking at the fundamental analysis and you don't know whether a company is making money or not, and you don't even know what its fair value is, how would you even know what's going on? How would you know whether you should enter a stock or not? But the price of a stock you see every day, it's apparent, it's clear, it's transparent. And its movements are very, very much in hand. And when it goes down or up, you see it right away. And so everything that happens will build into that price first. So you can be very, very responsive to whatever you see. And that's why this becomes very, very important to us. These three principles become the bedrock of technical analysis, and is the reason why we have to focus on what is this all-important price. Now, the definition said this is going to study market action or price. And we're going to do that by looking at graphs or charts. Now, the reason we're going to study charts or how to graph these prices is really because we want to see price in a very visual way. You know, when I see a picture, I get the impression of what the picture is all about. And I do it in a single glance without waiting too long. If you see a painting that you really like and you fall in love with that painting, it brings all sorts of emotions about it. But you see something you can't seem to understand and it causes so much confusion, then it's not a painting that you probably would buy off the wall. And so what we want to do is we want to look at the price chart so that we can get a visual sense of what prices are telling us. Because the movements in price, especially if it creates a trend, will give us information that we can use in our ability to trade the market well. Now, there's three ways for us to be able to describe prices for you or illustrate them. The first is really to use what is known as a line chart. Now, a line chart looks something like this. A line is drawn by simply connecting all the closing prices you get one day after day into a lengthy period of time. So we look at a line on close chart because we want to see how the basic movements of prices are. The problem with the line chart, it only sees a single dimension into price. You don't know what the highest or the lowest part of the day's trade was, and so the breadth of the market is quite invisible to you. However, if you're only after looking at trends, and maybe sometimes you might see charts like this may prove to be more confusing, then default into a line chart just so you can see where the market's drift is going, and that will take a lot of the confusion out. I still use line charts today, especially when I see heavy consolidations and I need to be able to look at something more material. I use line charts just to give me that essence of what it's doing. Now, a bar chart and a candlestick chart. Now, bar chart is a different way of drawing a graph. It uses 4 price points in doing it. It has the opening price, the high price, the low price, and the closing price. If you look at the image up here, you'll notice in this first bar chart that the opening price is drawn by illustrating a left bar into this stick-like candle you see over here. The left bar represents the opening price. The right bar that you see here represents the closing price. And the vertical line that you see here in the middle is drawn by connecting the highest price for the day to the lowest price of the day. So at the end of the day, you will have a left bar representing open, right bar to represent the close, and of course the high and low. That'll give you a range of what happened today. Excuse me. But it also tells you whether what happened in that price. Was it positive at the end of the day, or was it negative? Were people making money, or were people losing money at the end of the day? And if you're asking, why would I need to know that? And the reason is very simple. Is because if the market moves upwards and people are generally making more money, the tendency for that is to let them announce it to other people and get them involved and get a lot more demand to come into the equation and push prices up. So look what happened to the next graph in this case. Market opened here, went up to this high, turned around and fell to this low, and closed near the low. So in this situation, people who bought this in general for the day are losing money for the end of the day. And that situation does not allow them to be able to go out and say, hey, why don't you come to the stock market? Because just like me, I lost money today. So it does not encourage the ability for demand to come back on board. And even if you tell someone that story, I seriously doubt that they're going to follow you in. So prices moving up tend to be quite positive for the market and tend to be able to attract more funds flow towards it. Prices heading downwards tend to do the opposite and tend to keep people away, keep people in a defensive. You don't talk about things that you bought and that lost money. You probably only do the first. And so looking at these things will give you much more relevance into why we're looking at these charts, so that we can say to ourselves, I should be following with this, or I should be staying away from this. Now, another way of drawing this, which is, I would say, a more modern way of drawing charts, is using a candlestick type of charting tool. It's pretty similar to a bar chart like this. The only difference is how we draw the opening and closing price. The opening price and closing price is actually in-house in a box or a candle. If the opening price is at the lower end of that candle and the closing price is at the upper end of the candle inside will be colored a light or white color to represent that it opened in the lower end and closed on the upper end, and that you generally had a positive or upward day. Now, if the opening price of the stock is higher than the closing price of the stock, then the inside area of that candle will be colored a dark or black color to represent a down day. So if you were to look at the example here, immediately you can see this was up and this was down. If you were to do that in this chart here, you'd probably still have to think about it. And remember, this is a science of timing. And the faster that I can absorb what prices are telling me, the more useful a charting tool can be for me. And so this is the reason why candlestick charting is becoming much more popular now than what used to be a very normal bar chart, or perhaps even a line chart. But like I said, you can use any one that you want or feel more comfortable with. Nowadays with technology, you can click on a button in your charting app and you can turn a chart from a candlestick to a bar chart and to a line chart with one click anyway. So you can go ahead and do that, but practice it and try to see which one will be more prevalent in your trading style. Use whichever you feel more comfortable with. Putting one day of data to the next, to the next, and to the next, you will find out that each one of these charting types, charting the same price, in this case being the PSEI index, will show you the same data. There will be some minor differences in terms of the breadth, the highs and lows you will see in each area on the bar and the candlestick. But in a line chart, what do they all give you? They all give you the same representation in terms of trends. And this is the most important thing about this anyway. So like I said, whether you're using a line on close, a bar chart, or a candlestick chart, it will not change whatever the trend you follow or see. And to me, that is the most important thing that you're going to take out of this anyway. So go ahead and feel it. If you feel that the line on close is more important to you or is cleaner, then go ahead and use that. You can still draw trend lines later on it, and so the impact of which clearly will still be the same. However, if you're trying to be a bit more definite and precise, then the bar chart and candlestick chart will likely help you more because you can see the full range or the daily range of price, and that might help a little bit in drawing your trend lines later on. But the advantage of looking at an image is really quite vast. One, you can see and analyze information quickly. You can spot trend movements as they take place. You don't have to guess, right? And you can scope up many types of different instruments. Because I can read a chart of anything, I can now become an analyst of anything, commodity, a currency, a stock index, any stock, or even looking at interest rates. Anything that can be graphed and put into an image like this, you can now study and look at what the trend is, and you can forecast that particular conditions. All you have to do is understand the relationship between each one. And if you do that, you become an analyst of everything because you have the ability to look at a wide, diverse amount of information and put them to use and take advantage of that into our trading capacity. Now let's talk about the time frequency of graphs. Now, when you're drawing into a graph, there's several ways of looking at prices. If you're probably just starting this off, you'll probably encounter the typical what we call daily graph. In the daily graph, each bar that you see here represents 1 day of trading activity. So 1 bar, 1 day. And normally, if you're trading into the short term, you probably want to look into the daily graph to be able to use this to your advantage. Now, you can actually squeeze that data inwards and try to be able to look at a much wider variety of price. You can change your graphic construct to look at a weekly graph instead of a daily graph. In a weekly graph, 1 bar measures 5 days of trading. And so in that 1 bar, you're talking about 5 days being entombed there. So if you were to look at a sample that I have, this entire graph that you see here, which is about 6 months of data, is actually just placed within this dotted area that you see here. So this is just a blow-up version of this. And in fact, you can even look at a bigger graph called the monthly graph, where 1 bar equals 1 month of duration. And so this dotted line that you see here is actually this entire graph that you see here into the weekly graph. And this is just a small fraction of what you're looking at in there. Now, you're probably wondering, why would I need to be able to look at data so in such a wide perspective or maybe such a small perspective? Well, the reason for that is because the way you try to diagnose a market. If some of you are trading into the short term, then perhaps a daily graph would do with you. But it might be important for you once in a while to be able to look at the much bigger picture so you can see what the larger trends are that are involved here. And the reason is because you might see in the short term, there could be this little rally that's taking place into your stock. But what you can't see that in a big picture, your stock is involved in a major downtrend. And that eventually that downtrend is going to push that price back down. But since you're only looking at the minuscule, you're only looking at a small amount of data, you cannot see that the big picture is heading downwards. And that's my advice to you is, although you probably are going to go through your daily graphs and you can review your graphs every day using that, but once in a while, switch into a weekly or a monthly graph, maybe look something with a range of 1 year or 5 years, just so you can get an avenue of what does the major trend look like here. And is this something that I have to be ready with? Because if this is just a temporary rally and that the bigger trend will eventually launch it back down, you need to get prepared. And that's why looking at these various graphing styles will do it. You don't have to look at the monthly graph every day anyway. You can look at the monthly graph maybe once in a month or once every 2-3 months because those trends will not change immediately. But in a daily graph, you can look at it in as frequently as you wish. In fact, there's one more time frame you can look at, which is an intraday graph. I did not include it here anymore because I'm not talking about intraday trading as of yet, because I think these qualifying time elements will be sufficient for you to learn it. One day, if you want to ever become a day trader, then you will know how to be able to look into what is known as an intraday graph, where you can change the single bar to represent maybe 1 minute, 5 minutes, or 10 minutes of information, really depending on how fast you trade. So the more appropriate thing about this is choose the time of data that you need to make a good analysis of the market. Now, the final thing I want to talk about before I actually go into spotting trends really is really talk about the third dimension of price, which is volume. Now, volume measures the number of shares that you trade every day, or if you like, the value of what those shares that trade every day. It is usually depicted in a chart right below it. It looks like vertical bars, just like you see here, and they're directly drawn under every single day of trading and activity that you have. So the open, high, low, close of a stock is drawn here, and the volume chart is drawn below it. Now, what is volume? Since, like I said, volume represents a third dimension of price, volume usually shows you how big amount of activity is trading today in that stock. So if the stock of mine went up, let's say by a huge amount, but only traded, let's say, 5,000 pesos worth of activity, then you know that that big up move it made today can easily be washed down tomorrow because hardly any volume was traded. If 5,000 pesos was what used to push it up, then an equal 5,000 pesos tomorrow could easily push that right back down. And that doesn't give you a sense of substance. So what we want is a good amount of trading activity to follow our stock so that we know that good demand is following into the trend that we are following. So we look at volume because it'll help us describe a trend's following. Is it strong? Is it weak? If the following is not too good, then an up move of a stock may not last too long. Also, if, for example, a stock is falling down and it's falling down without too much volume, that means that decline could only be lasting for a while, and that could easily be turned around as soon as demand comes back up. So volume becomes very important here. It normally expands as the trend moves along with it, and it drowns away when the trend starts to weaken. But one thing I just want to be able to impart though is if ever volume spikes up by a tremendous amount out of the ordinary or drops down also extremely by an extraordinary amount, then these areas could be telling you that the potential turnaround, the trend could become upcoming. And so keep watch of that. If you were to look at the example that I'm seeing over here, if you notice there was an up move taking place here in the stock, all of a sudden a big decline just happens to be able to arrest the advance, and on the course of these 4 days a massive amount of volume comes in after the fourth day. So this tells you that after a big decline, good amount of demand came into the picture that took out all the selling that came out, and there probably is not enough sellers to push the stock price anymore. Eventually, look what it did. It turned the price out and allowed the stock to rally. Again, let's go all the way here on the right side and see this massive up move in price. In this massive up move in price, we have a tremendous amount of volume accompanying that swing. Like I said earlier, too much or too little volume may activate trend reversals. And so that means once you see this spike and volume is just too much, it could be that everybody who wanted to buy that stock bought it already. So who will continue to buy it tomorrow? And so you see these price spikes in volume or come together, that can flag a potential warning situation that perhaps a correction or a pullback in price is about to happen. So here's a classic example of how using volume along with price can give you a good realm or depth look into a company and see whether you should be alerted, move more into the defensive, or let's say volume is only starting to pick up after a trend is moving, then you can go ahead and become more aggressive buying that stock. So studying price and volume become the bread and butter of what we're studying into this next few sessions. Now, I want to be able to give you guys an overview of how to be able to activate the charting app into your COL interface. So let's have a look at it. So if you're logged into your site, you simply go into your quotes page, and you can come up and look for the charting tool here, click on it, and it will launch the charting app for you. Now in the app, you can put in a stock code up here, or you can come around to be able to input that in another way, which I'll show you in a while. So if you notice, I told you, you can actually change a candlestick or line chart. You can change the time frequency of the chart if you want to look at something greater, or if you want to look at 3 months of data, then you can. And so you can use this as your, as a sandbox to be able to look at the different perspective in price. This is a monthly chart. One bar here is equivalent to 1 month of trading. And so you can really change the perspective you're looking at depending on what trend that you're looking. Now, another thing that you can also come around to be able to do is build a watch list. So you click this, and what it'll do is you can now build, by clicking on this plus mark, the name of a list of stocks that you want. Let's say a mighty stock list of mine, and I'll put Ayala Core here, and I'll put Ayala Land, I'll put SM Prime, and let's say Meralco. Okay, click save, and it builds a list here. So instead of you having to type each code, you just click on the stock symbol, and it'll allow you to be able to navigate through each one of these. I've noticed some of our customers don't know how to activate this, so clearly just go ahead and do that, and then always click on this button here in the upper right-hand side and save so that you can use it again next time you come around. Also, by clicking studies, you can also indicate by creating the volume chart, or later if you want to use any other indicator, you include it. You can resize the shape so that you can see more data. Click the minus and plus signs to condense or expand the data. So the charting tool here is quite versatile. You can also use the select tool here to be able to draw lines, trend lines, channel lines, Fibonacci retracements. So go ahead and play around with it so that you can try to maximize your use of this. All right, so let's get into spotting and following trends. Now, we want to be able to understand why prices move. So the underlying reason why share prices move up is really because there is a huge amount of demand coming in and not so much selling or share supply coming out. And it's because of that that prices tend to be able to lift. If the willingness to buy overhands the desire to sell, then prices will move higher. If you have the opposite situation happen, and let's say, for example, okay, there's so-so demand, but the amount of shares exiting or wanting to sell are 2 times as much, then clearly prices are going to be able to head downwards. Underlyingly, that is the reason why prices move up and down. And so we just need to make that assessment and looking at how they move in charts so that we can get a good sense of whether these trends will continue or not. But at the end of the day, it's really the selling supply measured against your buying demand. If there's more demand buying than there are selling, then that's when you will have the movements of price taking place. So it is the intensity of the buying or the intensity of the selling that's measured here. And that is something that we have to understand. Now, how do trends continue? Trends continue because of sentiment. And what that means is, if the market feels bullish, what is a bullish market and what is a bearish market? A bullish market is supposed to be just like a bull. It charges forward with force because it has so much intensity. It could be that the fundamentals are so rosy that the economy is doing really well. It could be that earnings from companies are just so hard to ignore and that it's picking up quite solidly. And so without a problem being worrying investors, then you have the ability for the market to climb. It could also be because interest rates are low and that the cost of money is also quite available and there's a lot of money in the system that can also keep a bullish sentiment going. But then it could turn the opposite direction or bearish. Now, a bearish market is a market that's heading downwards. It's heading down because the sentiment is poor. There's a lot of questions about the economy. It could be earnings are getting softer. It could be like today that we are suffering because of particular disease outbreak that's keeping businesses stunted. And until that happens, the bearish sentiment will prevail. And so it's very important for us to understand what is the sentiment taking place right now, because if you understand what the sentiment is, it's very hard for the price to be able to go against that sentiment for too long. So if we've been seeing a rally in recent days, that rally might be short-lived because the sentiment is still rather on the defensive side. And we just have to be careful of what that can offer. So what is a bull market compared to a bear market in terms of the movement in price? So what we have here is what we picture of trend cyclicality, of how a market starts very, very solidly after a period of no interest, starts to hear rumors about businesses doing well, and eventually explodes in price. all the way up to a degree of optimism, instant wealth, and euphoria. But then it starts to be able to fall off and it starts to sag. Prices start to fall out very sharply. It makes an attempt to recover but fails to come back to its previous high. And because of that, a major decline starts to manifest. Now people fear, they become desperate. There's a lot of lost wealth in society, which contains the market from climbing. Yes, there could be a recovery, but it'll probably be short lived because the sentiment is still very weak. And then it starts to fall again until that note of pessimism and the period of no interest comes back out because people quite are doubtful of whether things will become rosy again or not. At the end of a bearish market comes the beginning of the next bull market. And this is why this is one gigantic cycle. I'd like you to be able to use this as your roadmap. Superimpose the charts that you will look at in the future onto this so that you can see where you are in this roadmap. Are you currently, let's say, coming in a place like this, or are you making a temporary recovery, or do we have to do this again later? Or are we now coming to a period of no interest or rumors? I don't think we're here yet, but more likely we're probably somewhere over here into our condition. So use this as your roadmap so it can help guide your hand in terms of aggressiveness. In a bear market, you don't have to be too aggressive, but when the beginning of a bull market comes, this is where your attention is quite warranted and your ability to be more aggressive is more warranted. Okay, let's start with the basic building blocks of what technical analysis will help us with. So let me introduce the notion of support and resistance. In order for us to study a trend, we have to start from the stepping stone of a trend. And this is what this is all about. Now, support is supposed to be an area underneath a market that shows heaviness in buying. Normally, when you're looking at a price chart and you see that it rebounds from a low, just like this, or this, then we mark these three areas out to be an area of support. Because what it does is it supports the price. It prevents it from falling. And it's because of that support that it encounters a substantial amount of buying interest that's so heavy that it allows prices to make a recovery. So support casts the prices back and shoots it back up into this recovery rally. Now, what is resistance? Resistance is that area above a market that stops a price from climbing. What causes that stoppage? Well, the heaviness in selling. People who want to profit take or who have said, this price is good enough for me, and so I will start to sell. And so what will happen, as you will see through our course of our lecture today, is that you will see that prices will come through these 2 points many times. They will bounce from support and get bumped off by resistance. And in doing that particular, or keeping that understanding in place, you have to be able to always understand that if I'm looking to buy this market, I should always buy the market when it's in my favor, when I feel that demand will help sustain its ability to climb. So if I were to buy this stock here and I see it going up and down, up and down, up and down, the best time for me to make a purchase here would be as soon as this falls down and rebounds off this supportive area, proving that support is there and that telling me that my underlying risk is now very small because I see that there's enough demand here to protect me and that it has now the ability to recover and make money for me. Imagine if I try to buy closer to resistance. If I see prices coming up and I'm coming towards an area where I've identified in the past that there's heaviness in selling, that means I'll be buying it closer to an area that will stop my price from climbing. And that means my ability to make money has been stunted. So I want to be able to make sure that my purchases are made closer to the supportive area, and I would rather look to take some profits closer to the area of resistance. So normally the lows of a graph will give you that area of support and the highs of a graph will give you resistance. Now it might be easy to look at in a sideways moving market like this, but many times in an upward moving market like this, the support and resistance areas will change. Now remember, support is identified by the low prices that you see here. So in an upward moving market, support climbs. It climbs on every successive low that you see. So if prices are pulling back down from here, you can say, where's my next support? My next support will be here. If this breaks, you can say my next support will be here. If this breaks, it will be here. On the same route, resistance is always dubbed at the area of the last high. So this will be your resistance, followed by this next high, followed by this next high. And so later, when I start showing you how to draw a trend line, you can project those areas of support out over time. And it becomes a very useful tool for us to use so we know where we can actually make our purchases from a stock and prevent ourselves from chasing a stock too much when it's running up like this, because we'll be buying the stock closer to resistance. Now, let's try to give you an avenue of how to be able to understand that degree of support and resistance. So let's go back to our charting app here, and let's just have a look at this. So in our ability to have a look, I have Meralco being shown over here. Now, here's a good sense of support. You can see the three lows that we've been seeing in this area seem to be containing the areas of support quite well. Let's just draw a line here just so you can see what that support looks like. Okay, so it puts a shelf in price, and every time it bounces off here, this is a good time to buy, a good time to buy, a good time to buy. As long as prices do not break the lower end, it's a good time to buy. A good time to take profit is every time it hits the ceiling of this area. Now, one thing you can take a useful look at looking at support and resistance. If the last rally shows a resistance that's much lower than the previous, that could be telling you that the trend is starting to change. And it did so in this particular capacity. So we want to be able to look at this to be able to give us good essence. Let's look at Wilcon in this case. So here's another uptrending stock during this period. And let's also draw some major lows. Here's one low. You can see when it fell here, it also rebounded because of support indicated here. And some of the lower areas we've seen are actually getting higher and higher. So just mark that out for you. Okay. And now with those particular lows, let's just try to draw a line that tries to contain as many of them as possible. This is known as a trend line. We'll talk about this in a while. This trend line shows you where the supportive area is. So it's a rising level of support. And if that supportive area breaks, just like you can see how fast the price started to be able to avalanche down. And so a learning that will come out from here is as long as the price holds over support, you can buy the stock from it. But the minute that supportive area breaks, then the cradle will fall. And it's in these conditions that you probably want to lighten up into your position or get out of the position initially. Now let's talk about the reversal of roles of prices here. Now we have resistance and support here as we draw in the earlier condition. Now, when we say the reversal of roles, I want to show you how what once used to be resistance will change its role and become support. So what happens in this particular case is after prices rupture through resistance, this is known as a breakout, and we'll talk about this into our next topic in our next session. And after prices move up here, you can see that there's a pullback in price. This area, this red zone, used to be an area of resistance. But after prices punch over it, this area of resistance changes its roles and now acts as support. The reason for that is because those people used to sell positions here found out that after selling all that they could, the price continued to be able to climb and they missed out on the opportunity. Also, a lot of people were thinking that this was not going to push out because they saw in the past that it's managed to be able to hold quite strong. And these people probably got left behind. So they're probably saying, if ever there is an opportunity that prices will come back to this zone, I will use that now as a buying opportunity to try to get back into the stock, or for the new people, a new opportunity to get back in without being too pricey. And so this now becomes a supportive condition on the price. Now, in an uptrending situation that would break, such as this, if this is your rising support line, and prices rupture below your support line, your former support line, after this break, will now be acting as resistance after the rally is actually being shown. So if you've missed the opportunity to buy, to sell your position in this crack, then in this next recovery, you probably want to be selling your position coming closer to where this resistance band will be. So similarly, if you missed the opportunity to buy this over earlier on, then you want to use this correction here towards support as your next buying opportunity to take advantage of this. And so understanding the reversal of roles should be able to help you understand when those next opportunity spots can come around to be able to do that. So let's have a look at an example of that in our charting app. So here we have Ayala Corporation, and let's have a look at typical support line. So we draw this here. There was a support break that you notice after prices turned around, and a recovery from the price will show you that it encountered resistance at the extension of that line. So here's support now acting resistance. And after that, you've seen that eventually the prices started to be able to cascade downwards. So these are conditions that you want to have a look at. Again, this becomes an area of support. After support is broken, in the next rally, this area that used to be support is now acting as resistance. It falls back down. It creates a new support. A new crack takes place. Prices fall down, recovers back to what used to be support, now acts as resistance, and now you have the same thing over again happening and happening. So here's a very useful tip for you. So remember, once those cracks in support take place, remember they change your roles. And so when a price rally comes inside, you can use that as a potential price target so that you know if you still have something to sell, where that you should be selling it closer to. As you anticipate this better, then it gives your ability to prepare for a market to be much more honed up. So now, let's talk about different trends here. There are three different types of trend directions. We have an uptrend, a downtrend, and a sideways trend. Now, an uptrend is simply upward moving markets that you see here. How would you know? Let's define what an uptrend is. An uptrend is simply a swing upwards like this that shows this type of quality. It shows higher highs followed by higher lows. High followed by a higher high, and higher high. Low followed by a higher low, and a higher low. You need those two qualities to exist for you to call this trend an uptrend. A downtrend is the opposite. You will see now lower highs followed by lower lows. Here are those lower highs, and here are those lower lows. So you put them together. If you see them together, then you know that you are in a downtrending environment. And finally, a sideways type of trend. I'd like to be able to define the sideways trend as simply an uptrend, not an uptrend, and a trend that's not a downtrend. So if it's not this and it's not this, it's automatically this. Generally, a sideways trend will have two lines drawn, and you will see that sometimes the highs and lows are almost the same, or they could be curved or angled a little bit, but usually about the same. And next session, we'll talk about area patterns so you can see what many of these sideways trends are like. But remember, if you don't see higher highs and higher lows, or you don't see lower highs and lower lows, automatically a trend is sideways. If you're looking at the chart and you can't seem to determine what it is, what the trend is, I would probably guess it is sideways. So until you can accurately find and define an uptrend in your chart, consider it a sideways trend unless you can prove that it's either up or down. Now, to be able to follow these trends, we will use a tool known as a trend line. Now, if you notice, I took out the blue and red lines here. But in this uptrending environment that you see in the first image here, I want you to be able to connect all the major lows that you've seen so far. So connect this low to the next low and to the next low. When you connect these lows together, you connect them with a line, and this line that you've used is known as a trend line. In an uptrend, the trend line is drawn by connecting all the major lows. In a downtrend, your trend line is drawn by connecting all the major highs. Please don't forget this distinguishing factor. Remember, in an uptrend, it's the lows that you connect. In a downtrend, it is the highs that you connect. The reason for that is simple. In an upward moving market, you ask yourself, what is the controlling element? The controlling element is the element of demand, the people who are buying the market. They are the one ushering the price upwards. Therefore, it is that trend line that you want to mark out because you want to know where these buyers are at any point in time. In a declining market, you will see that you will connect the highs because it's the high points where the seller stands. So all these highs are where selling intensity is the strongest, and it successfully turned prices back down after a recovery. So by connecting them through a line, But tops through a line, you know exactly where that seller will be, and you know where he will be in the future if you were come to extend that trend line out. And now you can only guess why trend lines become important, because they have the ability to show you where a turning point could be and where it could be later on. And that's why understanding how to draw trend lines becomes very important. In a sideways market, you will have to draw two trend lines, one on top and one on the bottom. And because you have a state of equilibrium here, where the buyer and the seller are pretty much in equal force. And so what you want to do in a sideways market is do what we call range trading. You've identified the low and high bands, and you will be buying this closer to the low after a rebound, and you will take some profits either on the way up or just after it starts to bank downwards. I would prefer you do it on the way up. So at least you can secure your ability to take some profits. Sometimes in a consolidation like this, when prices fall down, they fall down relatively fast and they fall down without too much volume. It might be very difficult to sell heavy positions that you currently are holding. In an upward moving market like this, you have one job. Your job is to look for an opportunity to buy, not an opportunity to sell. Right? So let's do entry conditions first. So our primary purpose is to try to see how I'm going to make money here, and that means buying this at the most optimum area, and that will be from here, not up here. You want to buy it on the way down or as soon as it rebounds off your support. Just like this is the appropriate entry point. Now, why, you might ask? Why isn't it good to buy here or here? Well, the reason is because of your ability to sustain yourself in there. Can you imagine if you bought your stock here and it climbs to this price? Would that still be profitable enough for you? Or what more if you're buying it closer to the high and you are now going to have to survive this on the way down and hope that you don't get shaken out? So it does not produce that effect that you want. You want to be able to make sure that your entry here is calculated, measured to your advantage. And that's the reason you want to do that. If you are caught in a downtrend like this and you're trying to sell a position, you should be selling that position in every single rally coming closer to that resistance line. So if you miss this opportunity to sell here, you should sell here. If you miss this opportunity to sell here, then you should sell here. Try not to be selling prices when they're falling down like a rock, because it is emotion guiding that hand. And you want to sell this into the rally so at least that you can recover a bit of the loss that you've had, and the volumes that are trading in that rally will be much more accommodating to the size that you're currently holding. Okay, now how do I use this functional trend line? So a trend line works this way. So if I were to be able to look at an image like this blue line is an example of an uptrend line. Again, you can see lows, higher low, higher low, higher low, higher low, higher low. Highs are also getting higher. So we have an uptrend here, and we connected as many of the lows as possible with this line. And given that context, every time I see a pullback to that line or close to that line, opens up a buying opportunity for me. So whether it be this one, whether it be this one, or whether it be this one. And you just go ahead and follow that through. Now you might ask, so when do I sell? Well, if some of you want to take your chances on selling at areas like this, my suggestion is you sell maybe 1/4 of your position or maybe 10, 20% of your position just to take a little profit. But the idea is, as long as the trend holds, try to hold your position. And it's only when the trend turns around that you want to liquidate. So an example of that is this. So here's your trend line, and you can see that the trend line here is broken after prices breach that particular trend line. So this is an area you should be selling. So whatever you bought here, 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 or here, you can now take good profit here and witness, of course, the profitability of that entire condition. So you sell. Now, when a downtrend comes, you can see now that when I see lower highs are being catered to, I will start drawing different trend lines. And sometimes I may need to adjust those trend lines, especially if the trend starts to accelerate. It happens sometimes, especially as a more firm trend comes into being. So, and later I'll explain to you why this happens. But whenever you see a high followed by a lower high, you can draw a downtrend line to represent the downtrend. If it accelerates and you see another lower high generate here, then from the last high point, you can draw another line to demonstrate what it is. So don't sell when prices are screaming down this way. Wait for the rally towards your resistance and sell it there. Don't sell in a screaming decline here. Wait for the rally to resistance before you liquidate your position. So we just put to practice what we've learned earlier on. So let's do that for real. So let's have a look at URC here. Now, so we have URC, and let's draw a bit of a line for you. So here's an example of a downtrend line. If you notice that we have resistance here, here, and for a while here, but eventually prices managed to break above that level, and a new trend was generated. In this case, an uptrend. And it shot up quite forcefully, jumped back up, went back up, retested the high, failed, and eventually broke through that particular trend line. And then look what happened to the price. It changed its course. So you can see immediately that when trend lines are broken, something happens to the trend. It can change. And then later we'll talk a bit more about that in depthly. But as the trend changes, you notice that I've been drawing my trend lines on the tops when it's going down and on the bottoms when it starts to recover. Once a downtrend breaks above, you can see the new trend line can be drawn, and now I can scope where the next levels of demand can be. Again, after the rally, bounce on support, bounce on the next support, bounces again on the next support, and then it cracks through the trend line area. This is a support break, and then turns the trend around again. So this time I have a new downward trending environment taking place. Goes down, tries to rally, and again, eventually breaks the downtrend, and it's only then that you have a new uptrend come back. So let's try to be able to scope out the new trend based on this. So you can see the next lows. There we go. And let's look a little further and adjust this. And now you can see that the next push into the price bounces on support, near support, the next one. And again, go ahead and buy in those rebounds. But the minute that trend line breaks, out you go. And you can see that you would have protected yourself from having to be able to bear through this next decline that you've had. So you can see what I'm doing here. I'm just doing over and over again as the trend continues, and I'm just drawing trend lines, and I use this to be able to push my entry and my exit into these prices a long time. And this is how a trend line can be quite useful for us, so we know exactly what to do when we see it. Now, trend line periods. Now, we need to know also the length of a trend, because when some of you start drawing trend lines, and I've noticed some people who would go to my seminar and they draw trend lines on their own, I will notice that you'll see so many trend lines in a single graph. And they look like pickup sticks. Now, the reason you would have so many lines is because you're quite confused at which trend in length to follow. You see, there are trends that are in short term, medium term, or in the long term. And looking at those trends would tell you that this particular trend should only be looked at if I am following the short-term trend. If I'm looking at a 6 to 12-month point of view, then I can look at a longer trend given the context of the line that I have here. And if I'm looking at something over the long term or over 12 months, then I have to have a piece of data that is at least 12 months in my chart in order for me to draw a trend line of that particular nature. Now, let me just make sure that this is quite clear for you. You should not have more than 1 or 2 trend lines per picture unless you're changing the time dimension of your chart. That way you know exactly what you're looking at. Now, you have to decide, will I be trading in the short term, the medium term, or long term? Once you decide that, you cannot change your mind. And the reason you're more likely to change your mind is because of a situation that the price is doing to you. For example, if I'm trading, for example, in the short term, and all of a sudden I bought a stock and I chased it, and I did not qualify by looking at my trend line then, and my trend line breaks. And because my trend line breaks, I'm supposed to sell. But if I sell this now, I'm not making money. I might be even losing. And now you will hear the short-term trader say, okay, maybe I won't trade in the short term anymore. I'll just trade in the long term. And so you change the tenor of time here to suit your purpose, because what's happening is that you were supposed to sell a stock because you were a short-term trader, but since it brought you to a losing position, you now say, oh, let me just take a longer time frame so that I can bear with this. But in actuality, what you're doing is wrong, because the time frame that you've chosen initially should be followed. If you really wanted to trade in the long term, you should be looking at long-term graphs. If you're looking at a short-term graph and not looking at the long-term graph, then this is where surprises will follow. So again, try to be able to make sure that you follow the trend period that you decided to. That way you're not moving from one term to the other. Normally, that is the biggest problem some traders will go through. It also shows a weakness in your hand because you can't seem to handle what you've chosen to do. So how do we sew this up in short, medium, or long? Let's look at pure gold. In recent days, you've seen a very strong upward path here. So I have 6 months of data. Let's change the time frame here. You can actually use this tool to be able to change whatever frame you have. So here's 3 months of data. Let's go back to 6 months. And in here, you can just move the graph so that you can do this. So let's draw a trend line for you. So you can see the up move that I'm showing you here. I'll click on the segment tool to draw a trend line. So I'll start in the lower end of the band, draw it up by stretching it, and eventually you will see that prices rupture beneath that trend line. However, it goes sideways, it doesn't go down. I'll talk about that also later. So right now we're seeing a sideways trend. Remember, there are 3 trends, not 2. So just because an uptrend breaks does not automatically mean it's going to go down. It could go sideways. Now, if I were to change this into a 2-year graph, you can see a very different picture now of this entirety. Now let's draw a trend line again. So now I'm going to be using this thing which I see in mid-2019 to this one in 2020. And you can see that a downtrend line, which used to exist, was actually broken here. And then a big upward move came in. However, it has not broken through the previous high here. So that means, based on this, we're still in a sideways band on that. Now, I will look at the 3-year chart now. This time I will see a higher high. I will connect it to the high in 2019. And if you notice where prices are currently consolidating or going sideways now is right smack on where this longer term trend line is standing. And that's the reason why that trend line is creating resistance here and allowing the stock to be able to wind up. But it seems to be quite strong because it does not want to pull back as of yet. So it is, it's with good hope that because this issue is taking advantage of the situation into the lockdown being a grocery, then hopefully that we might see maybe an extension of this advance, and maybe you might be able to see something that can come closer to the high of about 50, or maybe we're lucky, maybe even 54 or 55. So this is how we use trends to be able to establish what we're doing. And because of the longer term trend line, which is creating the resistance, it gives you better understanding why prices seem to be parking from here. So if prices push above this, then it might give us allowance to climb up to 50 or maybe even between 54 or even 55 pesos. And this is how we use trend line periods to help us gauge stock. Trend line parallels. Now, another thing you can do by using a trend line is by first drawing your trend line as the established trend is drawn out, and then getting a parallel line of this and drawing it in the bottom of the range. We call this a return line. Return line because after hitting the trend line, it returns closer to it. Again, the same thing here, it comes closer to it. Now, the reason we will draw a price channel is so that you can get a good semblance of the orderliness of how prices are moving. It's moving within a set range. And so if you guys are buying and selling this, and you're selling this, trying to buy back on the low, you should only be doing it maybe when it's rebounding off a return line. And it is absolutely preferred that you do your buying only in an uptrending environment. Try to resist buying downward moving stocks because it can be very difficult to do this and to catch those lows. Let alone that if you try buying it here, sometimes the up moves might be very stunted and you can just see prices falling back down again. But in an upward moving environment, you can buy your trend line rebounds and you can cast and take some profits off your return line. This is the more appropriate way of using a return line. But the job of a return line is simply tell you where could the high band be. So you know that if you are going to take some profit, and let's say, for example, you have a position and you think this is going to climb, by the time it climbs back up, you'll be knowing to take a little bit of profit closer to where your return line will be. And this is the reason why we draw a price channel, to help you get a sense of where the range will be. So first, again, start with your trend line. So let's say in a case like this, draw out a parallel or return line in the opposite end of the trend line. So if I do this, copy this line, push it up to this upper area here, and then draw it out. And then you will have an uptrend line, which you will use as a return line on that resistance. And in a downtrend, you would have, of course, your return line placed on the lower end of the range. So these are good buy spots for you, since it's a rebound of an uptrend and your uptrend line, and anywhere in this blue line is an area of support. These are not good areas to buy because they're closer to your return line or closer to your resistance line. If you're buying in the middle, it's half-baked. Yes, you might make a little money, but the risk is just equivalent as your potential reward activity. So it's really much better if you could buy this off a rebound of support. Selling or taking profits will happen into the upper boundary of the ranges that you look at. Okay, let's have a look at that. Here's an example of using a price channel. This is Ayala Corporation. We have a 2-year graph here, but let's look at the channel feature. You can click on this, and what it'll do now is it'll start drawing a trend line. But the minute you click it, it will allow you to draw the second parallel line, which builds a channel. And you can move it around to adjust if you wish. And here you'll be able to see where your support resistance areas are quite automatically. And it's proving helpful for us as a guide. After that, prices ruptured and they become much more accelerating on the way down. So we'll do the same thing again. So now we also have a price channel heading downwards. So again, you can see where the high and low bands will be. And let's look at this now on the lower band. After this big plummet in price comes in, let's see what we can do. We can draw one more channel here. Let's make it wider so you can see it. And it's cut from here to here, and draw the upper boundary, and there you have it. So this was just happening earlier on today. And so if you notice in the price chart of Ayala Corporation, after it made its first rebound, we drew this line up there. It seemed to be following the level of support. So these are good areas to buy, good areas to buy. And now we see prices all the way back up to the upper boundary here. Up here, this is not a good area to buy the stock anymore. In fact, if I had bought this here, I'd be looking to take some profits gradually into this move already. Like I said, when you're taking profits into an uptrending environment, then you want to do this gradually. You don't have to sell everything. And so you can keep yourself intact. And as long as this uptrend line is intact, you don't have to sell everything else. So if you want, sell 20, 30, or 50% of your position. And if it happens to fall back down here and rebound again, you can buy your position back. And that's how you can take advantage of a price channel. Now, I'd like to make sure you understand that as you're drawing price channel and looking at prices, you also have to understand it takes time for prices to turn a trend around. It'll not happen overnight. It's a process of becoming. A bottoming condition is a process of bottoming, and so is a top. So the general mood would be something like this. You have a downtrend, which after a downtrend, it makes your first rebound, but it makes a sideways shift first before it turns around to go up. Or in the opposite, an uptrend, let's say, for example, if you are in an upward moving market, it will go from up, then sideways, and then down. What you see here is an example of this one, a downtrend going sideways and then an up. This is known as a trend reversal. A trend continuation does a little different. So for example, what could have happened here is this was a downtrend, then go sideways, and quite possible this could have gone down again, and that being a continuation of the trend. So in a trend continuation, what could happen is a downtrend, a temporary sideways move, and then downtrend again. Or in an uptrending environment, it could go up, sideways, and up. So these are the combinations that you would likely see into a market. And always understand that from an uptrend, there's always a sideways trend that comes in before a downtrend comes. It's very rare, not impossible, but very rare that an uptrend will go straight down. It'll probably do that if something major and surprising comes in that nobody has factored in. And perhaps that could be the only reason why you would get a very, very abrupt or sudden change into the trend. And understanding that, remember, in a downtrend, after the first major rally and your downtrend line breaks, be careful about buying this immediately, because remember, it has to go sideways first before it turns around. And so you may have to prepare that after this rally, there might be one more attempt to be able to come down before the major reversal comes in and the market starts to move up again. I'm pointing this out to you now because it's quite possible we are in this phase of our market rally, and that later our market may need to do this before still making a reversal. So keep that in useful mind. So here's an example of a turnaround condition and a gradual one. Ayala Land. Clearly, you can see an uptrend here on the left side of the chart. Let me draw a trend line for you by scoping this entire move up here. Okay. Now, as the price are bouncing through the support areas, you will notice that right before the trend line breaks, you can see two highs that are about the same, and they didn't make a higher high anymore. And remember, our definition of an uptrend is a higher high and a higher low. This failed to do that. This failure here is the one that could possibly change the trend. The breakdown of the price is what confirms the change in trend. Now, after that happens, since this trend has now turned, I will now have to be able to draw a new trend line to encompass the downtrend I'm seeing over here. We'll just widen that so you can see the full range of that. And we'll demonstrate this again. This time, we'll see a downtrend. And I will now draw a downtrend line to cast this decline from here to here. All right, remember, it did bounce, but let's draw this line first. Here's a downtrend line. Then it creates a double base at about here. I'll just draw this sideways range. You can see how prices stopped here for a while, and eventually prices ruptured through the downtrend line, changing its trend and changing this sideways trend to an uptrend. And now I have something more meaningful to be able to establish. So again, it takes time to turn trends around. So in a downtrend like this, remember, here was the first major rally. After the first major rally, look at it coming all the way back down to the previous low and creating a double base. And after that, it makes a rebound, stops at resistance, and eventually breaks through it and changes the potential trend from a downward trend to a sideways trend into an upward moving trend. And this is how gradually a trend will change. So keep that again in useful mind so you know how to be able to navigate your market today. So to sum up what we've learned so far today, trend lines can be quite useful. So here's our Ayala Land as a chart. This is where we are kind of rather today. We've had a major rally. We've had prices pull back and create a new range between support and resistance. This is the first level of resistance. And I've drawn the second level resistance by drawing a little longer term trend line. And even a much longer term trend line is drawn above it. And so by doing these lines, I can now tell you where the first level of resistance is, followed by the second level of resistance and the third level of resistance. If somehow this first level of resistance at about 34.50 would break, then our next target would be this one. If this happens to break, then our next target could be this. And this is how we get the ability to see range. Because without this, then we'd probably be guessing as to where to anticipate prices will be. And at the same time, if you were to ask me, would I be buying the price today? I'd probably say not so much, because we're closer to resistance and not closer to support. And so what I would want is either this would fall back here, or this would fall back half the distance, turn around, make a higher low, and if a higher low generates my new support, then perhaps that will be able to allow me a new entry into a prospective move that can take me to either R1, R2, or R3. So again, the learning condition over here is, if I were to see an upward moving channel like this, Remember, your preferred buy zones are closer to your support. That's this area here or this area here. Please refrain from buying at this stage or this stage here because you're just around the corner to resistance and you could go through a major selling affair if you were to do that. All right, let's have a look at PLDT. Now, this has been one of the stronger stocks into our market, but recently, this is what just happened. So after punching out through a major downtrend channel here, and you see prices go up, it parked itself into an area pattern right here, right, where it created what was used to be resistance, and it broke above that resistance. But this time, you can see that an uptrend line has been recently broken. So that means that this probably needs to correct a little bit more. And because of that, I will now be watchful of where the next levels of support will be. Earlier, I talked about the reversal of roles. This used to be a resistance area. Now, after breaking it, this will now be acting as a support area. So if you're looking for a potential buy area, we'll wait for prices to either bounce from here or bounce from here before we look to be able to buy back any situation we have in PLDT. Again, what did I do? All I did was draw lines to be able to serve as guidelines for me. And these trend lines can now give me the value of range, can determine where support is, can tell me where resistance could be. And because of that, I am much, much more clear with my trading objectives because the avenue of trades are giving me an essence of what's happening. Now, whenever you have a very, very sharp up move like this is how you know you're chasing the price. You're not coming off a rebound of support. You're coming after a very, very sharp advance. And so when you see too much of this advance, you want to be a little bit careful about these particular types of conditions. We will cover what an overbought market will look like into our next session, so you can be more clear with that. But the idea here is to wait for prices to give a better setup closer to support. Also remember, a rebound of support is what makes the best entry and not a runaway condition like this. So try to wait, be patient. I know your hands might be itchy to buy the strongest stock in the board, but you have to wait. If you did not get the right time to pick it up, either from here and here, then you wait for the next best entry. Okay, so we've covered our topic for today. So we talked about technical analysis, where price becomes the more important factor for us. We talked about a number of ways to be able to draw a chart and how volume can help confirm that. We will use more volume into our next sessions when we talk about area patterns. And we also want to be able to highlight the importance of trends. We said that the market will go through a bull and bear cycle, and that we had to be able to describe ourselves, are we in an uptrend, a downtrend, or a sideways trend? And that when we draw our chart, that we have to be able to understand, are we trading into the short, medium, and long-term trend? We cannot be doing all three at the same time. You have to choose one. You can only serve one master. And we introduced the concept of support and resistance. Support usually drawn on the market lows or area bases. Resistance being on the price tops of the chart. And that trend lines being a very, very useful tool for us to be able to engage into the market. The value of a trend line by connecting the dots between our support and resistance is that you can draw it to the right and project where those support or resistance areas will be. So it can give you a good guide on where to take your profit or where to come in towards a potential entry. And finally, we talked about price channels being the conditions where in markets climbing or declining, they sometimes groove into very, very condensed ranges and something that is usually equally distant. And because of that, it gives us the ability to be able to buy and sell into the set ranges, helping our ability to gauge what markets are. And if they punch out or punch below these particular price channels, the tendency for them is to accelerate their trend and allow us to be able to move forward with greater force. So we've completed the first chapter into what technical analysis is all about. We will cover the rest into our next sessions. So in our next session, we will talk about corrections and the area patterns. We will discuss why the market needs to correct. We'll talk about what type of corrections do these things take shape in, and how do we come around to be able to take advantage of the corrective element of that market. In the week after, we will talk about technical indicators, and we'll discuss issues like your MACD moving averages and your RSI. And then in part 4, we'll talk about our trading plan, building the trading plan, and see how putting it all together will be the most valuable thing after we put in all the principles that we've learned into the exercises into this next 4-part tutorial.